Market to Market is everywhere you are. Subscribe to Market to Market on YouTube, find us on the PBS video app to stream on demand, and add our 3 podcasts on your favorite podcasting app.
Coming up on Market to Market, another run at leveling the playing field in the packing house. The climbing cost of inputs. Remembering a voice of the farm crisis.
But I just don't see a whole lot of that.
And market analysis with Matthew Bennett next.
What's the most complex industry on Earth? It's not genetics, or meteorology, or logistics. It's a business that involves them all. It's farming. Thank you, farmers, from Pioneer.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today.
This is the Friday, November 12 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Paul Yeager. The new $1.3 trillion infrastructure bill passed the House last week. The president is expected to sign the measure Monday. The spending bill news was overtaken by measures of inflation this week. At the wholesale level, the producer price index rose 0.6% over the last month and 8.6% from the previous year. Consumers also experienced the highest year-over-year increase since 1990. That was at the level of 6.2%. The monthly measure was up 0.9%. The high cost of items is a global problem. China's producer price index jumped 13.5%, a level not seen since July of 1995. The farm sector is riding the input price rocket ship this fall as well. Natural gas, the key ingredient in many products, hasn't been at this level since the cold winter of 2013 that rolled into 2014. The October spike is now trickling down to those looking to do some fall field work. Colleen Bradford-Krantz has more in our cover story.
The Ori family usually waits for spring before applying nitrogen-based fertilizer to their fields, but the recent spike in anhydrous ammonia and other fertilizer prices convinced the Earlham, Iowa row crop and cattle producers to make time last week.
Fertilizer's gone through the roof, and kind of why we're going after it as fast as we can now, make sure we get what we locked in to try and help secure profits or make next year more profitable.
Ori says they pre-purchased anhydrous ammonia in the summer, anticipating a supply crunch. But that price lock was dependent on application being completed before year's end.
That's kind of why the rush now for what prices have gone to and make it pretty difficult to get excited about next year. The ones that I talked to that hadn't locked in seemed a little nervous, hoping for maybe some better stuff in the spring.
The USDA's Illinois Production Cost Report from November 4th shows that anhydrous ammonia, a nitrogen-based fertilizer, hit an average of $1,205 per ton, just exceeding the prices reported in 2008. Prices for other fertilizer ingredients and blends have also climbed dramatically.
Starting out in June, July, when we had preseason prices, they were already high. And then going on throughout the season of prepay, trying to get people to commit to a price then. And then they just keep going up and up and up. But now it's at an all-time high that I've at least seen and that most of the growers that I deal with have seen in their lifetimes. I think every farmer's used to a little bit of uncertainty, but everybody's a little bit more stressed right now.
The commodity prices in most of the major grain markets have helped better position farmers to face this kind of financial challenge. But Brigham with Landis says many are analyzing spreadsheets as they decide how to balance against increased input prices, particularly if chemicals and seed prices also run high in the spring. The uncertainty of government support going forward makes planning even more difficult. U.S. net farm income in 2020 featured the highest percentage of government funds in recent history at 39%. That number is projected to be down in 2021 as COVID-related payments fall off. But the plans for 2022 support remain uncertain.
The things that they can rely on and focus on are their input costs, anywhere from fungicide to your fertilizer, your seed. You got to have that all down pat because that is something that you can control. And then the uncontrollables like government subsidies and Mother Nature, you just kind of got to roll with the punches on those.
The owner of another retail provider of agricultural fertilizer and other supplies, Ag Hub Midwest, based near Menlo, Iowa, agreed that farmers are at least discussing planting less corn, a crop where nitrogen application is more critical.
A lot of guys are taking a look at crop rotation, maybe not doing the corn on corn, maybe looking at a few more soybean acres.
However, both men advised not rushing any decisions.
There's a lot of instances that are, 3 times the cost per N unit, and it's a big sticker shock. And just trying to work through that with growers to regroup and put a plan together.
Samuel Taylor, Executive Director of Research for Farm Inputs at Rabobank, said the pattern shift began in the spring.
But right up until about May of this year, there was quite a nice trend line where commodity prices and fertilizer prices moved in a relative lockstep. I'd say since May, you've seen a fall off in the corn and soybean price. And at that point, you've seen a relative dislocation between the price of fertilizers and the price of commodities. And that's kind of shifted the affordability of a lot of these inputs.
Taylor, based in New York, said most of the causes are related to various public policy decisions, both in the U.S. and elsewhere.
You look for things like sanctions on the Belarusian potash production, which accounts for about 13 million metric tons globally. You look at other threats or risks of countervailing duties to products. You look at energy costs, so that's both in China and in Europe, particularly on the nitrogen side. And then you look at other issues like the export limitations on phosphates and urea. So you've gone from, let's say, August of last year through to May of this year, a demand-driven market. And then all of a sudden, from about May onwards, you've really gone into a supply-constrained market.
The market for natural gas, which accounts for 60% or more of the cost of producing anhydrous ammonia, is one of the key factors indirectly driving up nitrogen prices.
What you saw in Europe was you saw high natural gas prices curtail massive amounts of production. Millions of metric tons of capacity coming offline. I think it's something like 12% of ammonia production in Europe come offline, 25% curtailed.
Taylor says farmers may be able to shift money they've set aside for new farm machinery if it's unavailable due to supply chain or labor issues. However, he also encourages farmers to explore new options for boosting income, whether that's trying an alternative crop or participating in the government's carbon sequestration programs.
Farmers, and I include my septuagenarian father in this, farmers like to do what they like to do. And sometimes you need a kind of a glaring opportunity, but there is still the potential for growers to basically be rewarded for what they do best with historical things. I mean, if you look at things like the scorecard system on a lot of the carbon sequestration, rewarding you for no-tilling. Farmers have been no-tilling for a long time. Why not get a little bit extra on that? I try and think of something positive for growers for the 2022 season. Let's hope for good weather. Should we say that?
For Market to Market, I'm Colleen Bradford-Krantz.
The open market for livestock producers and buyers is a dance that fewer have been taking part in, as contracts and integration have taken much of the volatility out of the marketplace. That didn't change much in 2020. And in 2021, a group of lawmakers joined forces to introduce another attempt at leveling the playing field at the packing house door. Josh Bittner reports.
This week, a bipartisan group of 4 U.S. senators announced a compromise on steps to improve cattle markets by combining parts of previous bills into a new forthcoming Cattle Price Discovery and Transparency Act. The move comes on the heels of pandemic-driven meatpacking supply chain labor issues, which reverberated down to livestock producers.
How do you justify making such low bids when you're turning such a significant profit?
Senator Chuck Grassley of Iowa, a proponent of the bill, has accused the nation's 4 largest meatpacking corporations of operating in the shadows. Grassley has instigated several recent hearings to highlight the plight of declining cash markets for independent cattle producers, who have wanted to leverage volatility into robust price discovery, while meatpacker-driven contractual agreements grow, the likes of which dominate other sectors like hog and poultry production. But the bulk of such formula pricing is based on previously negotiated cash prices. The new proposed legislation takes a regional approach by establishing mandatory minimum thresholds of negotiated cash and grid trades based on each region's 18-month average trade, and requires USDA to create and maintain a public catalog of marketing contracts between producers and processors, while maintaining confidentiality. The American Farm Bureau and the National Farmers Union are among a number of state and national organizations which have thrown their support behind the measure. For Market to Market, I'm Josh Bittner.
Next, the Market to Market report.
The tightening of world stocks of wheat, a bigger corn crop, and a USDA report influenced the trade for the week. The nearby wheat contract jumped higher by 51 cents, while the December corn contract added 24 cents. The USDA report painted a smaller yield picture for soybeans, along with a reduction in exports as the January soybean contract improved by 39 cents. December meal added $29.40, or nearly 9% per ton. December cotton expanded 82 cents per hundredweight. In the dairy parlor, December Class 3 milk futures gained 6 cents. A mixed week in the livestock sector. December cattle added 33 cents. January feeders fell $1.87, and the December lean hog contract shed 67 cents. In the currency markets, U.S. dollar index improved 80 ticks. December crude oil decreased 44 cents per barrel. COMEX gold expanded 50 per ounce, and the Goldman Sachs commodity index added almost 2 points to finish at 582.45. Now here to provide insight is market analyst Matthew Bennett. Hello, sir.
How are you doing, Paul?
Good to have you here.
Yep.
You had a report this week. Were you surprised by anything that came out of there?
Yeah, I was a little bit surprised.
Which part?
I was a little surprised by the soybean yield, quite frankly. I think the trade was surprised too. I don't think Chinese buyers maybe got what they wanted there. I mean, I think most of us felt like this was a big bean crop that was going to get bigger yet. And so with your average trade guess at 51.9, most producers we talked to said that they had record yields or really, really good yields. Now you get into the Eastern Corn Belt, and I think there was a bit too much rain, and we kept hearing that trend towards the end. So kind of took the shine off of it, maybe getting to a 52.5 or something like that. But we guessed 51.75, Ag Market did, and 51.2 was a little bit lower than what we would have thought that it would be. But still, your carryout was 340, is up 20 million bushel.
Let's stick with soybeans then in that story. It is a smaller crop, less export demand. When you say the Chinese maybe caught the buyers, you're saying the Chinese are thinking there was going to be a drop on report day that they could come in and swoop and buy.
I kind of feel like they thought the crop was getting bigger, which meant that they didn't have to be in a huge hurry. It seems to me like world buyers have been a little lackadaisical here. And then also, of course, the Brazilian crop went in the ground a little bit earlier than what we saw a year ago, or even what we see a lot of times. We're talking about Brazilian soybeans being ready to go here by the end of the year on the export market. So I think a lot of these folks were thinking, hey, it's a big crop, we've got some time. And I'm not so sure that they felt that way after the report came out.
All right, so the meal was up almost 9-10% this week. Is that a driver in this story?
Yeah, I mean, a huge surge on Friday, and you get above your 100-day moving average. And so obviously on meal, I think it's just another factor that kind of helps this soybean market stay strong. Friday was a really good day, but on a percentage basis, meal surged much more than what soybeans did. So, I don't know that I would say I'm a huge bull as far as beans are concerned, but I do think that this week it certainly put an underpinning under the market that we didn't have coming into this week, not by any means.
A lot of green towards the end of the week. Does that give you pause for putting any sales on the books?
You know, I think that someone who was sitting around saying, I wish I would have gotten more beans sold, you know, you rally 35, 40 cents and you've got to stop and ask yourself, you know, what are you looking for now if you're not making that sale? Because there's no doubt that there's a chance you could go on up. You know, I mean, I'm not bearish necessarily, but at the same time, it's still a big bean crop and you still have the expectation that there would be a huge crop coming out of Brazil. 144 million metric tons is a huge expectation. But with that being said, you know, maybe there is some potential here because we are counting on the weather to be awfully good in South America.
Weather's been pretty wet in Australia, impacting their wheat crop. We're seeing a tightening of the world global stocks. What's that mean for the American producer of wheat?
You know, it's interesting because I don't think we got enough soft red winter wheat planted, first of all. Second of all, the growers that planted it, that we talked to are saying they don't like how it looks for the most part. You know, it's obviously not rated overly well. And so I think the wheat complex in total, I mean, 850, 860 wheat at times this week, you know, and then you're still looking in places like, for instance, St. Louis market, 20 cents over for next July wheat. To me, those are awfully good levels. Are we going to see this go on up from here? I think it's anyone's guess, but at the same time, I think this wheat market has performed extremely well. I think you have to keep Minneapolis wheat well supported on down the road because we're going to need a fair amount of spring wheat acres.
So the top of this chart says 840 for a range. Is that range going to get bigger, higher?
I kind of think so. I mean, this wheat market looks awfully strong to me. I mean, last year what you had was a lot of cheap feed wheat that got fed, okay? And so I don't want to talk wheat and corn at the same time, but keep that in the back of your mind whenever we talk about feeding stuff. But at the same time, you know, this wheat market, what's going to stop it at this point? To me, you've got much smaller world stocks, much smaller domestic stocks, you know, and quite frankly, I've got to think that your production situation is enough of a question right now that it's going to be hard to kill this wheat market overnight.
You won't mix wheat and corn, but I'm going to. Is wheat tied to corn and influencing corn's movements, or are the two independent right now?
You know, I think to an extent. You know, and I don't want to try to dance around it. I mean, but essentially, I think that the corn market's a different animal than what the wheat market is for the most part. I think when you look at corn, 1.5 carry out got dialed down just a little bit this week. Of course, you take yield up to 177, but when you've got a record yield and you're still looking at basis overs like we're seeing all around the Midwest, I mean, not everywhere, but in my backyard, we've got a 30 over basis right here on the heels of harvest, and you just had a 177 record yield. I mean, that's not something you typically see.
So what's that tell you?
That tells me that we came in extremely tight, first of all. Second of all, I don't feel like end users have originated as many bushels what they wanted to get, first of all. Second of all, ethanol grind's just been fantastic. So every day that they're able to run full capacity, they're making very good money.
Well, and ethanol had a couple of stories this week about maybe production was off a little bit. But is that just a breather? Or is that an indicator?
I think there's logistical issues on trying to get rid of the ethanol, you know, and I don't know that anybody is wanting to talk.
I thought fuel demand was.
I think fuel demand is good. I just think there's a lot of issues with some of your rail situations being able to get your ethanol and get it shipped out. To me, they're going to run full speed ahead if they can, any way, shape, or form. But I think some of them aren't able to if they can't get rid of the ethanol because they're hitting some stop gaps.
Well, the rail industry had not really reported many of the logistical challenges that, say, the trucking industry had. But you're saying that maybe the system is starting to have some backup somewhere, and that's trickling back?
It's definitely more than just trucking. Okay. I mean, in my opinion, you've got more issues than just trucking. But, you know, the trucking goes over a whole host of things. It's not just ethanol. You're talking, for instance, anhydrous ammonia, trying to get people to haul anhydrous ammonia. It's just tough right now to be able to source trucking really for anything.
All right. Before we move on to this question, corn, indicate a couple of indicators. Are you holding right now? Because a lot of things that you just mentioned give me thought that we're headed a lot higher.
You know, I don't want to sound too bullish. I got to think, though, that the holder of corn, if they call their end user and the end user says, hey, we're posting a 30 over bid, but I'll give you 50 if you get it here by next Wednesday. Then they call me and say, should I take 610 or 620? I'm not so sure that I should sell there. I'm going to say, why wouldn't you sell some corn there? You know, especially with some of the yields. I mean, so if you've got a national yield of 177, Paul, that means that a lot of people had record yields. Yeah. So if you had record yields and you're getting gun shy about selling $6 corn, we need to take a bit of a reality check.
Okay, you've said a whole lot of things that you've danced around this question because I told you ahead of time. But Jeremy in Lanark, Illinois asked you on Twitter, what will be the biggest impact on the acreage battle between inputs, demand structure, large South American crop, and fewer Chinese exports?
And I think that a whole host of those things are going to play in. Here's how I'm going to answer Jeremy's question. Right now, you're looking at a 1.5 carryout, just a little bit under that, 1.493. In my opinion, ethanol grind would suggest to me that you're going to have more demand there. Is the crop going to grow a little bit? Possibly. I think feed usage could grow just a little bit here too. Exports is probably fair for where it should be right now. But say you carry in a 1.35 next spring, you need over 90 million acres. And this fall has not been conducive to really good field work, first of all. Second of all, anhydrous run. So if you don't get a good anhydrous run, as we talked about the last time I was on the show, that poses serious issues, especially with the logistical problems we're having. So it's not so much input prices, because you can make good money at 550 D's corn, even with $1,200 anhydrous. I know it's not what we did for 21, so people might get a little ouchy when I say that, but you can still make really good money at 550 D's corn with 1,200 anhydrous. I'll say that all day long.
Does that corn price translate to anybody in the livestock industry making money, the feeder?
Right now, in my opinion, the feeders had kind of a rough week, relatively speaking, but feeders are still hard to come by and get a pretty good deal on them because people are wanting to feed. In my opinion, feeders are still going to be able to make pretty decent money because I'm fairly friendly whenever I look at fat cattle, and I have been for a while. Whenever I look at April, I think that we could get into the mid 140s, maybe even up to 150. And so I do think that better days are ahead. Demand's awfully strong. This BSE issue in Brazil is something that a person has to keep an eye on. And then who is our #1 importer of beef this week? China. And I don't think that that's something that's going to go away anytime soon. As their diet changes, they're going to continue to look to buy beef. And I think that we're their #1 place to go.
And China buying beef is news, in the last year. That was something that when we saw that come on, that was a big deal. So China also, let's stick with live cattle. You kind of talked about that. I'm going to move quickly into the hog industry. Which one, is China buying both beef and pork from us in the United States? Yeah,
but in my opinion, if you don't get them to buy a whole bunch of pork, that's whenever, in my opinion, we really struggle to rally, especially when we got over $100. You start to back off some of that export demand into China. But in my opinion, if you're comparing the two, where's the most increase likely? It's going to be beef. I think that you continue to see their per capita consumption of beef increase, and I think that that's going to keep them quite interested in buying U.S. beef.
What about the hog market then here? Let's talk solely about that. You excited?
I don't know that I'm excited. To me, I've been fairly bearish hogs for quite some time. When we got into the triple digits, to me, that was a tough place to be friendly hogs. You get into the $80, $85 cattle or hog talk, and I'm still I still feel like we're a touch rich. And so, do I think that we're going to go drastically lower? Not necessarily. As long as we can have really good exports again, I think that it's going to keep your hog sector fairly well supported, and I think prices could hang out in these $80 levels.
All right, real quick, last thing. Are you expanding either a hog lot or a feeder operation right now?
I think if I was going to expand one, it would be a feeder operation. And I know that it's tough whenever you're feeding expensive corn, but at the same time, beef demand has been awfully strong through thick and thin over the last couple of years. And I think that it spells good things to come, especially whenever your cattle on feed are not overly burdensome levels.
Matt Bennett, thank you so much. Good to see you.
Good to see you.
All right. Before we go tonight, we lost a frequent interview subject and farm crisis expert last week. Dr. Neil Harl served through Iowa State University in many agricultural economic roles and provided insight and guidance through the 1980s farm crisis. Tonight, we leave you with part of the 2013 Iowa PBS documentary on the same subject, which includes comments that make us take notice of today's landscape.
So what do current conditions mean for today's farmers? Some experts say farmers are much less leveraged, and as fate would have it, agriculture helped lead the nation back from the economic abyss during the latest recovery, as farm exports, commodity prices, and net farm income all soared to record highs. Rural land values also have climbed to unprecedented levels in recent years, fueling talk of bubbles and prompting some to wonder if history will repeat itself.
We don't know whether it may occur in 2020, 2030, 2040, or earlier. But it's likely to happen again when people forget the lessons learned in the 1980s. Now, right now, agriculture is doing very well, but I do urge everyone in the agriculture sector to think twice and to run in their business plans a worst case scenario, not just a best case scenario.
It isn't just somebody losing their job or losing a business. This was whole families that were involved, and it was, generations of families that were involved. And I think that that's important not to lose sight of.
You can't borrow your way to prosperity. The markets are going to change, and you have to be diversified. You have to be able to have, you have to have cash, but you need to keep debt low and not high and not over leveraged. And I think that's been the big lesson of the 1980s. What we need to have on an ongoing basis is an ability to compete in the world. If you give the American farmer the chance to compete in the world, he'll take out everybody.
Market to Market is a production of Iowa PBS, which is solely responsible for its content.
What's the most complex industry on Earth? It's not genetics, or meteorology, or logistics. It's a business that involves them all. It's farming. Thank you, farmers, from Pioneer.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today.